Okay, the tax chapter is so good that it requires two lecture videos. Our stopping point on part one was on the standard deductions amount. So once again, depending upon your filing status, married, filing jointly, head of household, single, married, filing separately, these are the amount of the deductions that you can put on your tax return in order to reduce your taxable income. Now, you have a choice of either using the standard deduction or what's known as the itemized deduction. So, with the itemized deduction, these are specific items or expenses, if you will, that can be deducted on your tax return to reduce your taxable income. So items such as mortgage interest on your home is a taxable deduction. State income taxes that you paid are a deduction. Items such as charitable contributions, medical expenses may be deductible. We're going to take a look at these different items that we can use under this category known as itemized deduction. So real estate taxes, the taxes paid on your home are going to be deductible. Even the personal property taxes in Missouri that we pay on our vehicles, our boats, cars, motorcycles, etc., are known as an itemized deduction. Your medical expenses may be deductible. It really depends upon the amount. So they made some changes. So in 2015, the medical expenses to be deductible, the amount had to be more than 10% of your adjusted gross income. The amount over is going to be tax deductible. So for example, let me get on my tablet again. Let's say your adjusted gross, no, don't do that. Let's say your adjusted gross income was $50,000. Okay. So of course, 10% of that is $5,000. Let's say we had medical expenses for $7,500. It's only the amount over $5,000 that's going to be deductible. That should be a 2. Therefore, $2,500 of our medical expenses could be put on our tax return as part of our itemized deduction. Your charitable contributions, money given to a qualified nonprofit organization, whether in the form of cash or property, those charitable contributions can be shown on your tax return as part of your itemized deduction. So we have the schedule called a Schedule A, and I know it may be a little hard to read, but the Schedule A is in your textbook, and this schedule shows the different categories of itemized deduction. So the first category would be your medical and dental expenses. We talked about those. Next, you have the taxes paid. Those taxes include state income taxes paid, local income taxes, real estate taxes, as well as personal property taxes. Then you have the mortgage interest deduction. Now in 2018, there were some huge changes made for the mortgage interest deduction. They put limitations on it, but those limitations are still pretty high. But there have been some changes made to this category in the 2018 tax season. Your charitable contributions is the next category. The last one deals with job expenses and other miscellaneous itemized deduction. So if you have unreimbursed expenses from your employer, then those items may be tax deductible, not the full amount. There is a cap on them, and they have to be over a certain dollar amount to qualify. But depending upon the amount you have in expenses from your employer that you are not reimbursed for, they may be deductible. So when you add these items all together for medical, taxes, interest paid, charitable contributions, job expenses, other miscellaneous. When you add those all together, if this amount is higher than your standard deduction, then you use the itemized deduction. If the standard deduction is higher, then you choose the standard. We always choose the higher of the two to reduce our taxable income. Personal exemptions. For each dependent that you have on your tax return, you're allowed a exemption, a dollar amount that you can claim to reduce your taxable income. Typically, there's an exemption for yourself. If you're married and you file them together, for your spouse, and for each dependent child. And each year, there is a set amount that you receive as a personal exemption. So if I have 4 exemptions, the amount may be $4,000 per exemption, then I can deduct $16,000 from my adjusted gross income to determine my taxable income. Another important thing, in 2018, the personal exemption has been taken away. I'll say it again, in 2018, the personal exemption deduction has been taken away. So now, once you have determined your taxable income, that would be your adjusted gross income, less deductions, whether itemized or standard, and exemptions. That gives you your taxable income amount. So depending upon the amount of your taxable income and your filing status, meaning are you single, married filing separately, married filing jointly, head of household, there are these different tax tables based upon your filing status. So for example, this is a tax rate schedule in 2015 for a person that is single. It is showing the amount you would pay in taxes based upon your taxable income. So for example, if a person earned $9,000 for the year as taxable income, then you would take 10% of that amount, or $900 would be the amount owed as their tax liability. You see here, depending upon the amount of your taxable income, it's showing you the actual amount of taxes along with the tax rate. Notice that the highest tax rate was 39.6% in 2015. Very important, in 2018, the tax rates did change. The current administration did change the tax rate. If you want to know more about those, go to the IRS website, irs.gov, to hear about the tax rates for 2018. So now, once you have determined the amount of taxes owed based upon your taxable income, it doesn't mean you have to pay taxes, because you may qualify for certain types of credits, as well as you're going to receive deductions for taxes you've already paid throughout the year. So for example, you may qualify for a child tax credit, okay? And this is saying currently, and once again, I don't want to keep, well, I'll tell you, this was current in 2015. The child tax credit, even in 2017, was $1,000 per child that qualifies for this credit. As of 2018, the child tax credit has increased to $2,000 per child that qualifies for this credit. You're all going to school. You may qualify for the educational credit. It just depends upon the amount of your tuition, what we call your qualified expenses, that is compared against any type of grants or taxable scholarships you may have received. And depending upon which is greater, you may qualify for an educational credit. There's also a tax benefit of putting money into certain type of college, say like a 529 plan. When you put money into these plans, what it does, it's going to reduce your taxable income and provide you with a tax benefit, because you're setting money aside for college for your child's future college expenses, and there's a tax saving from doing that as well. Earned income credit. Depending upon the amount of income that you earn, depending upon your taxable income, you may qualify for what's called the earned income credit, assuming that you have qualified dependents. And depending upon how much earned income credit you qualify for, it can reduce your tax liability and also provide you with an actual refund. It just depends upon the amount of your tax liability, the amount you qualify for in earned income credit. Other credits are things such as the child care credit. So if your child goes to daycare, you may receive a credit for that. There's even an adoption credit. If you have adopted a child, you may qualify for the adoption credit. So depending upon the amount of your credits, the amount of money you paid in taxes withheld already from your income, depending upon if you've made any estimated tax payments, that will determine at the end of the tax year whether you still have a tax liability and you owe money, or if you qualify for a refund. Okay? That will conclude our lecture over the tax planning. For additional information, be sure to read the chapter 4 information out of your textbook or from your ebook.